everyone. Mike Loukas, CEO of TrueShares here. Welcome to Off the Charts, which for those of you that don't know is our periodic video series where we speak with investment professionals from a variety of businesses, lots of portfolio managers, lots of industry experts. And today we're pretty happy to have Jon Browne from our sister company, RiverNorth. Jon's a PM on several of the funds at RiverNorth. And I would say, at least in my circles, Jon, probably one of the SPAC experts in my universe. So I appreciate you joining us today and sharing some of your thoughts.
Absolutely. Appreciate you having me.
So RiverNorth has been investing in SPACs since, I believe, 2015 institutionally, right? Before SPACs were a thing, at least in the retail marketplace, which has obviously the last 10 years have seen some booms and some busts in the SPAC space. So if we could, and I want to sort of go through this chronologically because I think collectively we believe that SPACs are back. But I would like to go through chronologically what happened. That they started to gain traction. There was a period of, I think, to quote you, euphoria, right? Somewhere in 2020, 2021. And then I think a severe retracement or pullback in interest in SPACs. And now they've started to resurface again. So for the audience, for me, as less than an expert in SPACs, let's first talk about what happened sort of between 2015 when RiverNorth started getting the SPACs and the end of that euphoria in 2020, 2021.
Yeah, sure. So we, like you said, we've been investing in SPACs since 2015, when they were, relatively underfollowed. Not a ton of SPACs IPOing each year, so sort of a small asset class. Here at RiverNorth, we were always looking for unique sort of underfollowed asset classes that have very compelling sort of risk return profiles, which is what we think pre-merger SPACs offer, right? You have the sort of yield play, which they're invested in treasury bills. So from a downside perspective, it's a cash plus type product, but obviously there's that equity-like optionality, which we find attractive as well. And so, that fit into our investment sort of thesis or our investment strategies. And so we started in 2015 investing in them. And then, really, for about 4 years or so, the market remained fairly quiet. But then, during COVID in 2020, we really saw the proliferation of SPACs, not only in the media, but with retail and then, sponsors as well. And I think the growth of that SPAC market can be attributed to a handful of factors. But one, I think that COVID actually itself played a big role, right? From a traditional capital markets perspective, and the IPO market kind of froze up in terms of, the COVID lockdowns, really prohibited sort of those road shows and other interaction that go along with the traditional IPO route. And so SPACs kind of stepped in to fill that capital markets need or void, right? You didn't need the lengthy road shows. You could have sponsors and private companies meeting one-on-one to basically determine, evaluation and bring those companies public. And so I think COVID itself really helped spur on the growth of the SPAC structure, and that helped really bring it to the forefront. From there, you then had retail investors, where you had zero rates. You had, sort of the start of meme stocks and, just, retail investors really, sitting at home, becoming interested in markets and so SPACs, were a way or marketed as a way for retail to participate in these IPOs that they've never had access to, right? And so it kind of was a self-compounding effect, right? Where you had a structure that for the time made sense. And then you also had, 0% rates effectively. You had growth momentum stocks, shooting up. You had retail investors who became very interested in private and public markets who were interested in investing in these SPACs. And so all of that kind of was self-fulfilling and led to more interest, more sponsors coming to market. You obviously saw during that time period, I think in 2020, around 250 SPACs IPO'd. In 2021, it was, over 600, which was quite surprising. But you really had sponsors who actually were in the SPAC market prior, right? Who had records of allocating capital, who should have been there. But then, the SPAC, it was quite easy for sponsors to bring SPACs to market, and you started to see other sponsors who maybe, didn't have histories of allocating capital, not to pick on sports stars or celebrities, they can also be investors, but
Now go ahead,
realistically,
pick on them. No worries.
yeah, right. Realistically, when you start to have individuals who have no record of allocating capital come in, that's when, you could step back as an institutional investor and say things have gotten out of hand. But really that's what, in my opinion, those are a couple factors that really, help propel the SPAC market to its euphoric sort of conclusion in 2021. And then obviously post 2021, everyone claimed that SPACs were dead, which, I would disagree with. I think they normalized, quite frankly, from that 2020, 2021 level. You saw traditional capital markets also take a breather after that time period. And so, SPACs aren't, while the structure is different, they follow capital market trends. And so you had a slowdown in traditional IPOs, M&A, et cetera. And so, we viewed it as it not being unrealistic that, SPAC should also, take a bit of a breather and normalize as well.
Yeah, so that situation where it gets out over its skis was sort of situation like a perfect storm, right?
It was.
We
It was.
Yeah, yeah. And then we have a fantastic way of sensationalizing things in this business. Like all of a sudden, SPACs are dead, right? Well,
Right.
if it was a good structure prior to that euphoria, you could argue that it's still a good structure. It
Right.
may have just been used improperly in certain circumstances. So, okay, we get the boom and the bust, and now I think we've heard a lot of chatter in the marketplace that SPACs are quote unquote back, and maybe that's, I don't know, maybe that's the other end of the pendulum swing from SPACs are dead, SPACs are back, um, but maybe they are, right? And I think you've probably seen signs of life, or at least signs of a spike in interest in SPACs again. How do you gauge that? So what's telling you that SPACs are back?
Yeah, I mean, strictly from a capital formation standpoint, I think, it's pretty easy to say that SPACs are back. Year to date, we've seen 89 SPAC IPOs, raising over 18.5 billion in capital, right? To put that into perspective, if you look back over the past 10 years, excluding 2020 and 2021, that's exceeded any of the prior years, and we're only in September here. So I would expect that to, continue at a healthy pace into year end. And so from that standpoint, that seems healthy, right? We have a good number of IPOs, which means there's enough investor demand to sort of fund those IPOs, right? We've also seen, 50 merger announcements year to date, which is also healthy, right? And of those, mergers, we've actually seen, unlike 2022, 2023, we've seen some interest in, post merger. Once the SPAC announces a merger, we've seen the price get bid up in the secondary market on a handful of those. I think roughly a half a dozen are trading at 20% or more above their IPO price. Some significantly higher. Specifically, we can think of some of the digital asset treasury companies, or some of the AI plays that appreciating meaningfully. But you also have 20 plus SPACs that have announced merger targets trading at 10% or more above their IPO price, which is fairly healthy as well. So I think strictly from a capital formation standpoint, we are seeing a healthy market. I think there's room for improvement. There's still 150 plus SPACs searching for merger targets. So over the next, 3, 6, 12 months, I think it would be helpful to see, a good majority of those find merger targets rather than liquidate. I think that would be another sort of sign that, the SPAC market's back and is in a healthier state. Lastly, I think we've seen a increase in the pedigree of sponsors, right? So we've kind of flushed out those sponsors who really shouldn't have been raising capital to launch a SPAC back in 2020, 2021. And we're seeing a lot of repeat sponsors who have brought SPACs to market in the past, who have merged with private companies and successfully. And so, to me as an institutional investor, it's really a good sign when you have quality sponsors who you can, have some confidence that they're going to find a deal and hopefully a deal that the market finds favorably and the price can appreciate.
So it sounds like there's an avenue for the SPACs are back moniker to stick, right? I mean, the market's got a funny way of introducing Darwinism at its finest, right?
Yeah, yeah, no, and I think you I think you were exactly right with the sensationalizing. Media likes to, you know, not really take a middle stance, right? And so SPACs were here in 2020, 2021. The death of SPACs were 2022 to 2024, and here we are now, they're back, right? And you saw a few underwriters, some in the bulge bracket banks who were big underwriters of SPACs during that COVID period, who swore off SPACs after saying we're out. Well, now they're coming back, and really all you have to do is just follow the money to realize that they never really left. They were never gone. It's just there was a brief hiatus where the market needed to normalize, and once capital markets sort of open back up, it's not a surprise to see those underwriters back as well.
Yeah, no, it's insightful stuff, John. Thank you. I know we didn't spend a lot of time on what an actual SPAC is, but if we want to give a sentence or two on why RiverNorth began investing in SPACs and sort of what you look for from an analysis perspective, then we can leave the audience with something meaningful to chew on.
Yeah, so a SPAC is just a blank check company, right, that raises a pool of capital that goes and sits in a trust that they effectively can't, we'll say can't access. And that trust is just invested in short dated treasury bills. So, realistically, a SPAC, a pre-merger SPAC, one that hasn't merged with a company, is effectively just a pool of treasury bills, right? Short-term treasury bills. Now, what the sponsor or the manager's job is to say, we have this pool of capital sitting here at our disposal. We want to go find a private company to bring public. And it's our hope that we can bring a private company public that the market, by market I mean institutional and retail investors, find favorable and are willing to pay more for once that goes public. RiverNorth, the way we view it, we only focus on the pre-merger SPAC space. And so that's from the time that they IPO to the actual time that they close a business combination. Because once they close a business combination, it's no longer a SPAC. It's a small cap or mid cap equity, which lends itself to a whole different analysis. But in the meantime, we're investing in the pre-merger SPACs because of the risk and return profile. We truly do believe that the pre-merger SPAC offers one of the best risk return profiles out there, right? Your downside is effectively a, treasury bill return, so a positive return. But here you are, when we're able to buy these at IPO, we're getting, maybe an overfunded trust. So we're getting T-bills plus some extra amount that the sponsor has to put in. And we're given these goodies, in the form of warrants, which if a sponsor finds a company to bring public, those warrants could be worth more money, potentially significantly more. So it's this free equity like optionality. And then obviously if the market finds a deal favorable, they can bid it up in the secondary market. And so, we've seen companies, some of these digital asset treasury companies that, when they announced the deal, appreciated by 50%, 100% overnight, right? And we can debate the rationality of that, but that is a market move. And so we look at it as saying, if we can provide our clients, cash plus returns as a downside, and on the upside, we can give you, momentum equity like returns. We think that that's a risk return profile that, quite frankly, you can't find in any other structure in the market today. And so from our standpoint, we're willing to invest in these SPACs when, maybe the deal announcements aren't appreciating meaningfully. It's more of a yield play for us where we're getting a Treasury plus type return, which we're fine with. But in an environment where deal announcements are being bid up in the secondary market and we're able to get equity like returns, we think over a market cycle that risk return profile is quite interesting.
Yeah, it sounds interesting.
Yeah.
And I know we don't like to go too long on these, but I'll let you go in a second here. So, in summary, SPACs are back. Maybe they never left. Maybe the rumors of the SPAC demise were greatly exaggerated, as they say. But as a structure, it sounds like it's still a viable investment opportunity. And for those of you that have any interest in SPACs or have a need for further education in SPACs, there's no better place to start than RiverNorth, and certainly websites are usually a great tool to learn about different strategies that include SPACs. So Jon, thanks for the time, and we'll look forward to having you on again. And everyone else, I appreciate you tuning in to Off the Charts. See you soon.
Thank you very much.